All right, so we've had 2 days now of very, very slow, small ranges after Monday's decline, support breaking the decline. And so while the support break has so far held, it has not been extended. And it's not been extended far enough to where we can't come right back above those levels. So I'm going to break down kind of this expectation, these patterns in the chart that look pretty bullish going into this Jackson Hole meeting that everybody's looking at, and suggest we may bounce into the weekend going into next week and then remain on this bullish intermediate run. But I'm also going to show you just how tenuous that is, like this support is. Like if we weren't able to hold it, if we weren't able to get down, what that would mean in terms of our expectations and how bullish or bearish we're going to be. So I'm going to show you that. Stocks didn't move today, but a lot of other things did. So I'm going to show you what other asset classes are moving and how what those implications are. And then our trade idea is a stock that can really, like, maybe potentially make a good 2 standard deviation move or more if stocks do rally into the weekend and into, for that matter, the rest of this year. So let's go ahead and get started. Today is Wednesday, August the 24th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going here, I invite you to subscribe to our YouTube channel with that icon or the subscribe button down below the video. Also hit that thumbs up down below the video, that likes our video. Also comment down there on anything that stood out to you. Join our website at MarketScholars.com with that link up there. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out these things over here on the right. Come down to the bottom, click that heart. It opens up this tab. Hit that like button. Also with this thumbs up icon, click on that. It opens up this tab. Hit that like button as well. Again, the more you do that, it helps get our content out to all of our followers on those social media platforms. All right, let's get started with the S&P 500 and take a look at what it's doing today. Really, really quiet day again. Yesterday we had a 35-point range. Today a 36-point range. So that's coming off of Monday's 65-point range. It doesn't include the gap. Had about from the close 42.28 to the high of 41.95. So you're looking at about another 30 some. I mean, you're pretty much about a 100-point range on Monday when you include the overnight session. And then down to 35 and 36 today. No gaps needed to include there. So obviously, you know, as bearish as we were there, coming back down below all these really important Fibonacci lines I pointed out to you previously, the 62% retracement of the intermediate run, the 50% retracement, that's the famous one that a lot of people have been alluding to, of the entire decline since the beginning of the year, and then the 23% line is the bull rally, the bullish move off the COVID low point. So we have been retracing it, and then now getting above it assumes that we're done retracing it. But again, Monday proved that might be a fake out type situation. So we'll see. You had really, really bearish short-term sentiment going into yesterday. Both the momentum and the near-term line finished below the 5th percentile. You know, again, not very common to get both those lines down there. The last time we did was over here on April the 22nd, when they were both below the 5th percentile, you know, and that kind of started this run. We were kind of only light pink shading and yellow line going into it, and then we had that down day. Now, we haven't had 2 down days like those two, both over 100 points in range. So we're not as bearish, but the intermediate line was only barely above the 50th percentile, was not in bullish territory then, like it was yesterday, just barely at the 81st percentile. So, you know, really, really bullish posture and a very bearish short-term sentiment. And so, again, that one could not get above. It took a while for the near-term line to get out of bearish territory, and it was only briefly bullish. So you would hope, from a bullish standpoint, that would not be the case here. Otherwise, the expectation is that we're so bearish that it's going to be a while in bearish territory here. And it might, you know, when we do finally get up in the bullish levels, it might be hard to break. See, the bullish range for the blue line is, you know, up above 80 and pretty much up above 90 with lows just below 40 and not below 20. That's the bullish range. Obviously, that's not the case. The range for bearish range would be down in here below 20 with peaks, you know, above 60 and barely above 80. That's more of a bearish range. So if we have indeed broken out of the bullish range into a bearish range with that low point, then again, the expectation is we wouldn't get nearly as strong of a bullish bounce coming up. Light pink shading shows up because we are below the 80th percentile now on the intermediate line. Market sentiment lines rallying. It's actually almost up above the chart's midpoint. So, again, getting above 60 is when you're bullish, but getting, we are out of bearish territory and we're almost in the upper half of the chart. Pretty decently bullish sign. You actually are, I believe it's on the Russell 2000. Yeah, you are barely above the 50th percentile on the Russell 2000. But again, the Russell 2000 on Monday also broke important support lines. You can see a red and a brown or orange and a green line all at the same levels. So we broke an important one that we had just barely broken above, and then the NASDAQ did the same thing too. So the NASDAQ has got this orange, the red, and the black lines with the 50% on the green kind of all sitting there together right here. We broke below all four of them on Monday, and now are still holding below them just barely with very, very small ranges and very oversold short-term sentiment. And its intermediate line again also almost into the upper half of the chart. So basically we've pulled back down the 30-day moving average, and now we either bounce off of this as you would expect we would, right? Because the trend is bullish, dark green shading in the green line. So the trend is bullish. So the expectation from a market forecast standpoint is we bounce off of this. And probably won't do it tomorrow because you're still going to have people, waiting for Friday. And the Jackson Hole event typically is a non-event from a monetary policy standpoint. They don't typically promote their current policy stance like they do, like the press conferences. They don't take questions and things. So I wouldn't expect like the Jackson Hole thing to be a big event. It hasn't been a big event. It's been widely anticipated for however many years, but every single year nothing comes out of it that they expect would. And so my expectation is nothing will come out of this meeting either. And that very well could push us up as the market is kind of anticipating maybe a hawkish stance on inflation that might be able to pull us in back above these lines and come off of this low point, and which obviously would be a higher low point than what we saw here previously. Now it's not a higher. If I go back to the S&P 500, it is not a higher near-term low. So the last near-term low is right there. It's actually kind of an equal near-term low. On the Russell 2000, it is a smidgen. It is actually significantly higher because the near-term line here did not get into bearish territory. So this would be a higher low on the Russell 2000. On the NASDAQ 100, it is actually a slightly lower low. So it did drop into bearish territory here, and we are actually below that line. So we held support there briefly. We did not here. So but we're also not significantly below it, and we're also still sitting there at the 30-day moving average. So let's take a look at the long-term chart, and you can see again, we talked about we're not getting a higher close, so it's a bearish candle, still no upper shadow either. So let's see how we end up finishing the week here. But PPO is still rising. We don't have a red arrow, so we're not. We have one of the three things you need to turn back to the downside. So there's still really no significant concern there. From a 3 green arrow standpoint, everything has 2 red arrows. Nothing has 3. So there's still, there's no green shading, but there's also no pink shading. And that's very typical during bullish trends that you get, periods where there's no shading in between the green. These are buying opportunities. You see it a lot. If I were to go back out, even if you might get a day of, pink shading in there. But when you're bullish, there's lots of no shading in between the greens. And those are all pretty much bullish opportunities. And you can see that you might get a brief one, like a 3 red arrow signal, and then those are buying signals. You just tend to go right back up. During bullish trends, you tend to just go right back up. So you can see some over here and some over here as well. And there's multiple. They eventually turn in the green shading. So we do not have the pink, the 3 red arrows, so the 1 day of pink shading. Or a yellow line, but we also don't have we also have clear shading. That's just as bullish as any of these others. You can see lots of clear shading where there was bullish opportunities there too, and we just turned up off of those lows. So there's a very good possibility that that might very well be the case again here. And you look at the 2-line version of the chart, and you can see we have pulled back down below the 17-day moving average. We have not crossed the 30. We have not crossed, the MACD is still below its moving average. It has not crossed below 0 yet. Stochastics has dropped into bearish territory, not too significantly. It's just barely below the 40th percentile. The orange line still very bullish. If you look at the stochastics on this basis, we are in the lower half of the chart, but we're not into the bearish territory yet. So, and your average is still very bullish. So, you know, we're not bullish, but we're also not really bearish. The DMI, the negative indicator got up to the 25 level, but it's come back down. And the positive is still dropping, but still easily above 25. When you look at the RSI and the CCI, we pulled back, but we pulled back to 50. We pulled back without getting below minus 100. So these are all levels that very well could prove to be buying opportunities. We pulled back to the blue line. We didn't get below it. And we're still easily above the cloud. And again, very good chance, unless we really break down hard, that we stay above the cloud as we get to the green shading, which means we can get a good trend going forward from here to the upside. And we don't have a mature strength trend anymore, but you're still pretty darn close on SPY, and I believe on IWM you're about the same levels, and the Qs do not. So the Qs have lost their bullish trend. So a little bit of a concern there. And then the other concern too is the Arun indicator. Again, we are below this number 70 here, and we will be. We're going to get to what comes after 68, 63 tomorrow, and we will get to 57 on Friday. So by the time Jackson Hole comes out, we're not the 4-week low point is just going to move up to there for tomorrow and up to here for Friday. So that's why it's still going to be on the last day. So the red line is still going to be at 0. The high, we're not going to touch new highs in the next day or two. Probably not even Friday. No matter how bullish we are on Friday, we probably won't get it on Friday. So that high tag is just going to keep moving closer to day 1 of the 20-day period. So which is 0 on the Arun indicator. So when you look at this high tag and the low tag, if they're charted, that's what the Arun indicator does. The green line is the high tag, and the red line is the low tag. 0 is the first day in the 20-day period. 100 is the 20th day in the 20-day period. So the high tag just keeps going towards the first day, so we keep dropping towards 0. And again, that's kind of the first step of a reversal, is that the green line drops below 70, and then the red line spikes to 100. So that means we get a new low point. And so for that to happen on Friday, remember, this will move up on Friday to, you know, this low point here of 406.77, and that's 406.82. So this will be the low point, right? This will be the red line. It will be at 0 on Friday. So for us to get to move that red line up to 100 on Friday, you can see, if you follow my cursor all the way to the right, that's how far down we'd have to drop. And you can see, if we drop here, if we don't hold that 30-day moving average and bounce, and all those indicators bounce, as we expect that they will, because that's what you expect support to hold until it doesn't, then you can see how bearish that would be, because we would drop below this and there's just nothing down here. There's no, in fact, most of the volume is about right where we're at. That's why we stopped here. And so if we break down, I mean, it can get a lot more dicey and get a lot more bearish. We can drop below the 30-day moving average, get below these 38% retracements. There's a lot less volume down below this level than there is above it. So you can kind of see how important it is that we kind of hold these levels here. You know, we'd also be below the value area in the 1-year chart, which is another significant thing. So hold support and bounce. If not, you can see how bearish it can get very rapidly. The VIX actually dropped today, dropped down 5% after peaking. It's still in neutral territory. So even though it's dropping here, the other's dropping too, so you're still relatively high. You're not dropping back down below 90%, which is what you need to be back to being bullish again. You need to drop back down there. But on a good note, it is holding. The VIX is holding as the correlations have recovered now. I showed you that correlation before. Here, the VIX correlation. So now that the VIX correlation here has recovered back to positive levels, hasn't gotten all the way back up, but at least it's back above 50%. and you can see a good little pattern there, a bearish pattern. But you can see also that the VIX has had its head up against some, that its 200-day average value and its 50-day average value. So if it holds this and we roll over, and this is as high as the MACD gets and the stochastic gets, you can see how the moves to the upside are a lot faster, and then we just kind of slowly move to the downside. The moves to the downside, you can see, look at the MACD. We go up fast, and then we move slowly down. We go up fast, and we move slowly down. We go up fast, and we move, in this case, we actually move down relatively fast. But you move up fast, and you start to slowly grind your way to the downside. So if this is it, then you expect that we'll slowly grind our way back to the downside, more than likely getting back below 20, which would be a significant change in this regime, in this volatility regime. We talked about the change in regime over here when we broke above 20, that we were going to have some volatile 2022, at least the first half. That would be a significant change in the regime in the opposite direction, where the second half will be not very volatile at all, hence pretty darn bullish if we can break back below 20. Break above the 200 and the 50, however, and do these highs, then you can see how bearish that would be, because now we're looking at a move back into the 30s, if not higher 30s, because again, we still have never gotten the move where the VIX got above 100, significantly above 100% during this whole time. Briefly over here, but every time over here that you started the day above 105%, you finished the day a lot lower. So this day right here in the middle is the only day that we actually close this close to 105%. For a correction, it's rare. Typically, corrections we get to 115, 125%. So the fact that we've only gotten to 102% is incredibly rare for a correction move. And the washout move was over here in June, the June lows. That's where things really hit the fan. We didn't even get above 100% on the VIX. So it kind of goes to show that we still maybe haven't even had that washout. I don't know if we will, but it goes to show that how if we get back below 90, just how this regime may be changing, because we never did really get that bearish there. So again, the expectation is support will hold until it doesn't. So we have to expect that we'll bounce into the weekend and go up. But if we don't, then you see things can now really start to pick up the pace to the downside. And not that we'll tank, right? We're not going to tank again. I doubt we're going to have the same kind of move that we had in the middle of June. But we will get a move up towards 30 in there, and it might take a little bit longer. But September and October, you'd expect to follow the seasonal pattern of bearishness, which would again make it less likely that this is only a correction, and more likely that we'll eventually head into a bear market the longer that we don't recover this correction low. So that's how I'm looking at it. What do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree with what I brought up here. What charts or indicators are you looking at that would suggest otherwise from what we've talked about? Post those in the comment section down there. All right, now let's talk about what's driving the price action today. We'll take a look at this asset comparison chart like we always do, and let's just look at today alone. So we'll go to August the 24th. Coming to like a 5-minute chart. Initially, real estate and small caps both did well, which is crazy because at the very beginning of the day, you had yields higher, you had commodities higher, you had the dollar higher. That's not a recipe for bullishness. That's been the trend, right? To have those things be so much higher, emerging market stocks started the day really negative. By the end of the day, however, commodities had pulled back, bonds had rallied briefly in the morning, and the dollar had pulled back too. So things are looking pretty positive. The stocks peaked on that. But then from about the noon Eastern time forward, commodities rallied to finish the day with the strongest gains. The dollar ended up, relatively bullish, ended up off of its lows, not at its highs of the day, but off its lows, and bond prices finished at their lows, a lot closer to their lows of the day, which means yields were up. Let's take a look at those moves here. If you take a look at the 10-year yield, it's up to 3.1%. So again, significant move on yields above their 50-day moving average. The 8 and 17-day are crossed above the 30. They're rising above the 23% retracement of this pullback that we've had. That's been so bullish for equities. Commodity prices have jumped above their 50-day moving average. The 8 and 17 are crossed above the 30. They already did even prior. They're close, both of them crossing above their 50-day moving average. You can see commodities looking to get above the value area on the 1-year chart. If you look at TLT, it's below its value area and easily below these moving averages and dropping there. You can see how much it's dropping. So big moves to the upside. The dollar gapped up again, a second consecutive day where we opened up and then fell. This time we actually didn't fall as much, and so that's why we're black and not red. We actually finished the day higher, whereas yesterday we finished lower. But second consecutive day where we started the day up here near this highs and came down. So it's trying to get through this resistance and seeing if it can actually do that or not. If you take a look at the Euro US dollar, which makes up 53% of that dollar index, you can kind of see what it's doing. It's trying to figure out whether or not this is a divergent low point or not, whether if we're going to come off of that, or if we're going to and really reverse, which would be really bearish for the dollar, or if we're going to continue this trend to the downside now that we've broken through parity and work our way towards those 2,000 lows, which again would not, the idea is that would not be very bullish. That would kind of further this correction, and then with the dollar that strong, that's what led to the bear market in 2000 to 2002. So and how long that bear market was because of how strong the dollar was. So you can kind of see we're getting a little bit of a divergence pattern forming, and the momentum isn't nearly as strong anymore. So we'll see how the dollar performs, but that's not the case for TLT, right? TLT, we are rolling over from a high point there and getting back below. This is a long-term value area, the 5-year value area, and breaking back down. Just to kind of give you an idea of, it's how far, what it's got, how much it can go down. It can move down to the 90s where we were after the great financial crisis. Bonds were down just below 90 at 88. The TLT was, and then down to 82 at its lows during the really good housing move. So needless to say, like, this is not the lowest that the ETF has gone, and it can go lower. So that kind of gives you an idea of. Just gives you a sense of, if we do break down here some more, we are in this bear market. Bonds are in a bear market. The expectation is bonds lead stocks, and stocks haven't even gotten below their 200-week moving average. Bonds have gotten below it and have been below it now for pretty much all year long. So that kind of gives you an idea. And again, the same thing too, that currencies kind of lead bonds, and you can see what the euro has been below its 200-week moving average. Before bonds did. Dollar rallied there sharply here, and again that will lead to an eventual rally in bonds, which typically coincides with risk aversion, right, with equities dropping. So it kind of gives you an idea here of what's driving the price action today. So if I go back to the last 3 days of last week here, so let me go back to the comparison chart and go back to the last 3 days of last week too. So let me go to August, and then over here the 17th. And remember again, that's when the narrative changed, right? We had, this idea that commodities were softening, that would, the Fed would stop raising rates, so rates would start to fall, and inflation's peaking. Commodities since has jumped up 5.5% in these 5 days? 1, 2, 3, 4, 5, 6 days. Commodities up 5.5%. The dollar's up sharply. 2% over that time frame, and bonds are down. You can see the Qs are down near their lows at 5%, and small caps are off a little bit more off their lows there. International stocks still holding up well despite the strength in the dollar. So we still haven't seen that change. It's been quiet the last couple of days after but it hasn't been quiet for commodities, and it hasn't been quiet for bonds. Some of these things, even though equities aren't moving, some of these other asset classes are, and that's, you can see why we have the narrative change that we have. I'm sorry, I picked the wrong one. Let me go to the comparison chart here. And if I were to go to those same 6 days. So starting with the 17th, going through to today, go through the same 6 days from a sector rotation standpoint. And again, you can see utilities and staples outperforming by half of what the S&P's lost, and energy up 8%, XLE up 8%, kind of following commodity prices higher. XLC still down near their lows. XLY, XLK also down near the low. So until these three sectors can really start to make a move, now they are trying to make a move. When you look at the RRG chart, you know, again, let me just update this here for the last couple of days. You can see XLY and XLK are trying to make a relative performance move up to the upside, and you can see these other safe haven areas are not. So that's, you know, before that it was, if I go out 6 days, so those same 6 days here. So here's today from yesterday, and then the same 6-day pattern. You know, you can, as commodities around, you can see energy and materials are really starting to move up to the upside. Energy materials are moving up to the upside. XLK and XLY are moving up to the upside, and all your safe havens are moving down. You know, to kind of give you an idea of what that looks like from a weekly standpoint, even the weekly charts, energy materials moving down, utility staples moving down, with real estate, and XLK, XLY, XLC moving up. They have the strongest momentum right now. So again, you can kind of see the rotation behind that support holding, that we can really kind of bounce off of this and go up, and we are shifting. The markets are trying to shift to where XLK can get back above its relative strength line. If I go XLK over here, I hit update, and then drop down to change this to like VTI instead. There we go. So you can see, you know, it did dip to its relative strength line, and the relative strength is dropping, and you got some momentum, but it appears the momentum may be kind of slowing down. We might be able to reverse that relative strength line back to the upside. This is on a daily chart. On a weekly chart, it looks like this. All right, so if I were to go back out 10 years, that's what the weekly chart looks like. So increasing relative strength on the weekly chart because of this break that we've had over the last so many weeks, that may be kind of pushing us up in the right direction. On the other hand, like a day like today, this little, you know, pause, we're still down. Like the Qs are still significantly down versus IWM. On a day like today, MACD is dropping. We're easily below the 17-day moving average. Like again, that's not a good sign. So if by Friday we reverse this and go back up and this little support holds, we're going to need to see this jump back up above, you know, at least the 8-day, if not, you know, the 17, and start to reverse this relationship back to the upside. Because if we're not going to, if we can't depend upon IWM to lead us up to new high like we did and when it went parabolic in early 2021, because that was a pure like vaccine related reopening trade move that, you know, obviously we don't have the case right now. Right now you have a very wide disparity. You have you know, these companies, XLK, the two bellwethers in XLK making up a record amount of the S&P 500, XLY making up a large amount too, XLC, you know, you're looking at almost 4% with Meta down here at 5%. Meta is now out of the top 10 biggest companies. So there's your XLC. XLK also got this little bit by NVIDIA. Like those three sectors are you know, however many stocks, 7 of the top 11 stocks in the S&P 500. The market will go as they go, right? As they go in a market cap weighted index. All right, now let's take a look at our trade idea of the day. So I wanted to take a look at Netflix. Right? If this support holds and we bounce, Netflix has really good potential. You can see it got light pink shading. It did not quite get the yellow line, but we did pull to the moving average. We got about 0.5% above it. Short-term sentiment was pretty bearish, but the intermediate posture is still pretty strongly bullish. It's not above 80, but at least it's still in bullish territory. So it's kind of setting up the same potential bullish move as the S&P. Obviously, it's coming off a much bigger low point than the S&P is, so it's got some really good, decent potential to the upside. It's still above its 10-week moving average. The PPO is still rising, just like we talked about with the S&P. When you look at the moving averages here, as I mentioned, we had gotten below the 8 and 17, but not the 30. So we're still holding there, and the gap between the 30 and 50 is widening. The MACD is not dropped to negative yet, even though it's below its moving average. And stochastics is only dipping its toe below in bearish territory. So there's a good setup at this volume support for us to bounce, to hold support at this moving average and bounce back up. And the nice thing is, if indeed we do bounce back up, there is no volume up here. So we can really get going on a bigger than normal move because there's no resistance. It's like a knife cutting through hot butter instead of cold butter. Right? You can still cut through a cold butter with a knife. It just takes some more effort, but you can still do it. You can still get to those levels. But if you have a hot knife going through butter there, then even just at room temperature, then it can get through it really fast, right? And so considering that you don't have very much volume in this area, we can get through there really, really fast. So that is a I like that opportunity. So what I decided to do is I came over here to its options chain, and we decided to do a long call option. So buying the at the money call option with a 50% stop order puts my risk at my normal $1,000 risk, which is not typical for a directional trade like this, but considering how expensive the options are, I kind of have to work with that. So that gives me a $2,000 maximum, but of course we would get out with a 50% stop order, which we got that stop order pending or working. And of course, if I can get out earlier, if we don't bounce, right, and we start to break down on Friday into the weekend, then we'll just get out with less than $1,000 loss, ideally with like $500. But if it does go up, and not just one standard deviation, but two, up to that 350 area, which is right up here at the top of this gap, if we can get up there by October expiration, that's a $9,000, almost $10,000 reward for ultimately what would be probably about $500 of risk by the time we got out of this trade. $1,000 if we get stopped out, $2,000 at the worst. So that's, at the worst case scenario is 5 to 1, but more than likely, you're looking at about a almost 10 to 1 reward to risk ratio, or better if we can get out before the stop order. So really, really good reward to risk ratio because of the setup here with the lack of volume on this gap. If we ultimately hold the support and bounce and break through, as again, kind of a cup and handle type formation would form, as again, that would be anticipated because again, you always expect support to hold until it doesn't. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, subscribe to us at our website, marketscholars.com. Like us on Twitter and Facebook. That goes a long way for us. So thank you for those who do that. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.